Hi, folks. This is Big Mike Zlotnik, and today's discussion is going to be compare and contrast real estate investment trusts versus private real estate funds. So first of all, let me start with a definition of real estate investment trust. It's a real estate investment company focused on income generation. That's the most typical definition of REITs. And REITs are, generally speaking, are publicly traded. There are exceptions. There are some private REITs, but wide majority of REITs are Wall Street REITs. Effectively, you can buy and sell as a stock on Wall Street. In comparison and contrast, private real estate funds are private. They don't trade as publicly traded securities, and they have different type of strategies versus REITs. So REITs, generally income focused. Private funds could be focused on income. They could be focused on growth, and they could be focused on growth and income. Also, from a life cycle perspective, most of the REITs buy assets that are performing, also known as the core assets, that have good income generation engine. Effectively, these are properties that have completed the value add phase of the project, and they are effectively cash flowing, and they're holding the investment for long-term cash flow. What private real estate investment funds often invest in are value add phase of the project. And the value add phase of the project could be many things, but let me give you some examples. Value add could be development of a ground up self-storage facility, and then stabilization, and then sale to a REIT when the property is completely stabilized. So the value add example here generates substantially higher return on the investment, but it does carry a higher level of risk. REITs typically acquire performing, more stable assets. They take less risk, but they generate lower level of return. So it's one of the basic differences between the REITs and private funds is that the private funds have the ability to generate higher returns as a result of the value add strategies. Other value add strategies are multifamily value add. So private funds would typically come in and buy properties that have been somewhat aged, and they have rents that are too low, and there's substantial upside to get these properties renovated, stabilized at the higher rents, and then get sold to REITs. That strategy has also taken place many times, where private funds come in, do the value add work on multifamily, and then exit the property to a REIT, and the REIT buys it for cash flow. So that's one of the critical distinctions. The other distinction is REITs typically are large, 40,000 pounds gorillas in a manner of speaking. So they need to have assets of larger institutional quality. Private funds can participate in a smaller assets. So an example would be on a multifamily scale. A REIT would love to buy a property with 1,000 doors, large institutional quality, buy it for 180 million. So these type of large assets work as a good, well-matched economy of scale type of investments for REITs. For private funds, there's a lot of specialization in smaller assets, medium-sized assets, and some large assets too. So the private funds have a lot of flexibility what they participate in. In addition to that, private funds may have greater flexibility on the strategy they execute. For example, Tempo family of funds have a broad mandate. We at Tempo are capital allocators, so we can shift the strategy. We do love self-storage, we do love multifamily, we do love industrial, and so on and so forth. So we have ability to shift depending where we see the opportunities. REITs are more or less locked into their primary strategy. That's all they do. A self-storage REIT is not going to buy multifamily assets if suddenly some interesting opportunities open in that sector. So those are some of the differences between REITs and private real estate investment funds. Another way to think about REITs versus private funds is private funds operate on a long-term basis with a long-term horizon. They can execute value as strategy with less focus on an immediate quarterly performance, 1 or 2 quarters, because they're looking to maximize risk-adjusted return. They're looking to maximize their strategy. They're looking to maximize capital allocation. Some of the REITs they live quarter to quarter. One of the ways to think about this, because they're publicly traded, they report results on a quarterly basis, they need to show performance every quarter, good healthy performance. If they start underperforming for whatever reason, they suddenly get beaten up by the investors who get nervous what's going on, why the REIT is reporting somewhat less income. So it's a different strategy, different type of reporting, different part of the life cycle. They're different. For some folks, a REIT's a phenomenal investment opportunity. For some other folks, they do much better by investing into private real estate funds with the folks they know, like, and trust. That's another huge differentiation between 40,000-pound gorillas REITs versus private funds. So these large REITs, they typically have publicly traded vehicles with the full executive teams. And these executives are not easy to reach to. They operate almost the same way as any other large institutional player. Getting a hold of the senior folks is not easy as an investor or a shareholder. On the other side, with the private funds, you have the ability quite often to get to know the executive team, who is operating a given fund, what strategies they execute, how they think. You can actually build, know, like, and trust, which is a gigantic difference, in my view, versus investing into a publicly traded REIT. I hope this was helpful. This gives you a little bit of a color between the two. There are a few other differences, but in general, they both provide great hedge against inflation, as real estate is one of the best asset classes that provides hedge against rising prices, rising costs. That's one of the major reasons folks consider investing in both. But private funds, in many ways, have greater flexibility, greater benefits, great accessibility to the management, while REITs just trade as a security on Wall Street, and it is subject to a greater volatility as a result of that. Anyway, hope this was helpful. Appreciate your time and attention. Until the next time. Thank you.